But I have said all along that I really appreciate getting questions from everybody. Questions are a very important way for me to understand what the issues are that people are experiencing. So I look forward to hearing from you. I hope you do send me questions. I hope you do send me comments on some of the things we've done. Regulators are one of those bodies that we should speak to and hear from more often, and we don't hear from you enough. So I really look forward to you using that email address. And it's gone. Okay. All right. So now we're going to talk about a new project, a project to replace IFRS 4 as it stands at the moment. This is probably one of the toughest discussions to talk about. When Vienna and Christoph were talking earlier, I'm sure you got an idea that insurance is not a simple subject. It's got a lot of complexity and a lot of complicated calculations that happen behind the scenes. I'm not going to try and go into all the complexity. I'm going to take what I think is about a 30-page slide presentation in the book that you've got, and I'm really just going to talk about 10 slides. Okay, the first 10 slides. And I've even cheated on one of those slides, and I've expanded them a little bit more. I've got a little bit more detail on that. If you have any questions on the rest of the slides, please feel free to send me emails or to ask those questions now or to ask those questions whenever. But hopefully with the few slides that I've picked out to talk about, I will be covering most of the issues that you actually have in insurance. So where are we at the moment in our due process? We're about to release a new exposure draft. A new exposure draft is the second exposure draft we've had in the insurance project. It's a long document. It's probably about 350 pages long. The basis of conclusions, which tells what we thought about when we made the decisions, is probably 250 pages of that. And the reason why that is so long is because the basis of conclusions has to summarize 21 years worth of discussions that we've had on this. So there's an awful lot of reading in there, and your eyes will go square. But right at the end of the presentation, I'll mention that we're only asking a few questions. We're not asking a lot of questions on this, because a lot of the things that are in this insurance standard relate to questions we've already asked in the past. We've already sorted out most of the issues, and there are just a few questions left that we're going to cover. So timeline, revised exposure draft will be out in the first half of 2013. Now I should point out that 30th of June is also in the first half of 2013. So that kind of gives you roughly the date I expect it to happen on, very close to the end. We hope to issue the new standard in the second half of 2014. Now probably the same point, the 31st of December is also in the second half of 2014, so that's a viable date. We will give approximately 3 years. So this thing is only going to be out in 2018. And as I mentioned, that'll be our 21st birthday, so we'll probably have a glass of champagne to celebrate. In fact, I think most of us will be very happy to see that standard go out the door. Why are we doing it? Well, you heard from the previous presentation. All these various accounting models, estimates that are not updated in certain circumstances, discount rates based on all sorts of weird and wonderful things, non-discounting in some places, little information about options and guarantees. These are all the things that we're trying to improve, all the things we're trying to fix. When you look at that presentation I gave an hour ago, and what I forgot to say is that whenever I present on IFRS 4, I'm actually embarrassed. I'm embarrassed that there's so much variety and so many options and so many different ways. It really is a horrible standard to talk about. So those are the things that we need to fix. And we need to fix them as a matter of urgency. So we're going to push this project along and make sure we finish it quite quickly from this point forward. Okay, so what are the principles underpinning the view? And this is maybe my favorite slide. So I'm going to apologize to you if I spend a lot of time on this slide. Okay. Insurance is about the liability. Every question people ask you about insurance is about the liability. Okay. Why? Because what happens with almost every insurance policy you can conceive about, the insurer first receives the money and later pays it out. There's almost no insurance policy I can think about except maybe some reinsurance policies where the insurer first pays and then receives. Okay, so it's very, very seldom that an insurance product that you're looking at doesn't involve a liability somewhere in the discussion that you're talking about. So when we talk about insurance, what we're talking about is how do we calculate the liability. And this page is how we calculate the liability. So as I say, I'm going to spend a bit of time on this one, and don't get worried about whether I'm going to finish, because this is probably going to be most of the presentation is going to be here. Starting from the bottom, cash flows. Okay, now, you gentlemen mentioned cash flows. Cash flows is the most important thing here. What am I talking about cash flows? I'm talking about all the cash flows that I expect to happen in the over the course of the contract. Okay. How do I determine the contract? And I think, Christoph, you mentioned contract boundaries and how important contract boundaries are. How do I determine what's within those cash flows? When does it start and when does it finish? So what we say in order to determine the contract boundaries, we say the contract starts, the starting point of the contract, is either the date on which coverage begins or the date that I receive the first premium, whichever is the earlier date. So sometimes I might receive a premium before coverage starts. That means I'm already obliged to give coverage. I have no choice. I've now received, the other party has executed, therefore I'm in this contract. But generally speaking, the coverage period and the payment happen on the same date. So when coverage starts, when I am now at risk, if something happens from this date forward, I have to pay. That is the date on which it starts. So all cash flows that occur on or after that date are part of this contract. When does a contract end? A contract ends when I, as the insurer, can reprice it for risk. And I can reprice it for the risk specific to the policyholder who's actually in the contract. Again, what do I mean by that? If I am obliged to continue providing you coverage for as long as you continue paying, and I can't change the amount I'm charging you, then my contract is indefinite. The contract ends when the event happens. Now, many life contracts are designed like that. The life contract will say on day one, I pay 1,000, and I pay 1,000 for the rest of the life contract, or sometimes I pay 1,000 plus a 5% escalation each year. The point is that if I sign the contract, I'm a healthy 21-year-old. I sort of remember what that felt like. I'm a healthy 21-year-old, I'm active, I'm doing all the right things. I sign the contract, they say you're a healthy person, that's great, Mr. Scott, we're going to give you the special allowance. 2 years down the line, I buy myself a Ferrari and I start driving really fast and I start smoking and I drink all night. If the insurer knew me now, they wouldn't give me that rate again. But tough, they've given me the rate, they stuck with it. That means they can't reprice. It means they're already in their contract and they have to live with their contract for the whole life. It means it's all the way through. If the insurer is allowed every 10 years to say, okay, Mr. Scott, you now need to come in for a medical, we're going to test to see if your lifestyle is right, and we're going to change the pricing if we believe it's appropriate to change the pricing, then that's a 10-year contract. And it runs for 10 years until the date I change. Most life contracts run for life, I guess that makes sense, or they run for term life, they run until you're 65 or something like that, and when you sign the contract, you've agreed how much you're going to pay. Most motor vehicle contracts run for a shorter period, they run for say 12 months, and at the end of 12 months, they will look and see how you're driving, they will look and see how people who drive the same kind of cars you drive, they will look to those type of things so they can reprice for 12 months, every 12 months. So I'm looking forward 12 months. In South Africa, the way short-term insurance works is that you buy in short-term insurance, the price is fixed for the first 12 months. Thereafter, the insurer can change it any time. So what you have in South Africa is you have a 12-month contract, followed by lots and lots and lots and lots of 1-month contracts. Okay. So that's in essence, if I'm now looking at it, that's how I decide what the contract boundaries are. There's one other point on this one, is that sometimes with health products, I have a slightly different scenario. What happens with a health product is I buy the insurance today and I pay that amount for a year. At the end of the year, the insurer can reprice the pool that I am in, but they can't reprice me. So if I suddenly find after 9 months on this contract I have diabetes, they can't reprice me because I have diabetes. But they can reprice the group I've got, so everybody who's in that group might be repriced. That is also repricing for risk. So in that circumstance, the health contract is a 1-year contract. Okay, that talks about the contract boundaries. Importantly about the contract boundaries, though, is that determines the contract boundaries in this circumstance are determining the coverage period. They're not talking about claims. Okay. The claims are the claims that relate to that particular contract period. So if I take a 1-year policy, my boundary is 1 year. I've taken the policy from the 1st of January and the policy ends on the 31st of December. That's the boundary I'm looking at. So the cash flows I'm looking at are all the premiums that come in, all of the claims, all of the expenses, all of the things that relate to that policy within that 1 year. But we have IBNR, as you mentioned, and IBNR means that I might have a claim, I might have an event that happened during that coverage period, the 15th of December, but I only find out about it 30 years later. Now, that sounds ridiculous if you're thinking about cars and driving and crashing, but things like asbestos claims took 30 years to emerge. So it's possible that I might have a claim that comes very far out. Because the event happened during the contract period, it's one of the cash flows I need to think about, even though the cash flow, the physical cash flow itself, might happen after the end of the period. Because the event happened within that period, I take it into account. The cash flows that I must take into account, which cash flows? So we talked about the contract boundaries, the beginning and the end. Which cash flows am I taking into account? I'm taking into account all the cash flows related to that contract. That might be premiums, it might be claims, it might be acquisition costs, the amount I spend to get the contract, it's fulfillment costs, it's claims handling costs. So it's all of the cash flows that relate to that particular contract. Okay, that's cash flows. All right. Easy enough starting point. That's the basis of where I start. What am I doing? I'm taking all these cash flows I've looked at, I'm spreading them out into the future, and I'm looking at what I expect them to be. So I expect that I will receive a premium every month, and I expect that I will have a claim after 63.758 years. Okay. What does expected mean? What does expected value mean? Expected value means the probability weighted expected cash flows. That means I shouldn't take count of only one cash flow, because if I'm looking at a life policy, there's a chance that the person might die tomorrow. So one of the cash flows I have to think about is the possibility of a cash flow tomorrow. There's a chance the person might only die after 110 years. Okay, it's a small chance, but some of us keep hoping. So there's a chance that I might live for 110 years. I need to take into account that scenario too. So what I need to be doing in doing this is I need to take into account all the scenarios when I'm doing an expected value, and I need to probability weight all of those scenarios, give them a probability of that one happening. So there might only be a probability of 0.00001% that I'll live to 110, but if it's a probability, I need to take that into account. Importantly though, just to help insurers with this, we said you need to take into account all the scenarios you normally consider when you're pricing the contract, when you're measuring the risk of the contract. So we're not saying go out and imagine the scenarios. We're not imagining the alien abductions and things like that that might never happen, that just might happen. We're saying the scenarios that you take into account, the information you have. So it's a little bit like we said yesterday with impairment. You use all the information you have available. You don't ignore any information, but you don't have to go and invent new information or look for new information that you would never consider. Okay, that's the cash flows. Any questions on cash flows? Great. Okay, you guys comfortable, because I'm particularly worried about keeping you happy. Okay. All right, so bottom block, that's the first one. That's my core thing. Now remember what we said about cash flows is they spread over a long time. So the second element that I need to take into account is the time value of money. Time value of money, a cash flow far in the future has a lower value than a cash flow right now. It's why when you talk to some insurers, they will happily tell you that they actually pay out more. The money that they pay you on your claims is more than the money they receive on their premiums. Why? Because if I'm receiving the money today and for the next 50 years, and I only have to pay you out in 50 years' time, I can do stuff with that money for the next 50 years. I can earn interest on that. So we need to recognize that money far in the future is worth less than money right now. So I need to now look at all those cash flows I've determined, and I need to discount them back to today. I need to calculate a present value. I was really happy when you guys spoke about present values, because some insurers are telling us they don't know how to do present values. I already now know that the Austrian insurers do, so that gives me a really good sort of happy feeling here. Okay, so time value of money. Time value of money, the really important thing about time value of money is what discount rate do I use. The lower the discount rate, the more those future payments actually are right now. So if I think about this, if I'm discounting an amount, if I'm going to receive 1,000 next year, and my discount rate is 5%, then that 1,000 at the end of the year at 5% would go into my books right now at 950. But if I said I'm going to receive 1,000 in a year's time and my discount rate was 50%, then I'd only show 500 in my books right now. So there's a very big difference that comes about when I'm talking about the size of the discount rate. And the higher the discount rate, the lower the present value of future cash flows. How do you calculate the discount rate? We said it needs to be a discount rate that is based on the liability. So it's a discount rate that you calculate taking into account the factors in the liability. What is the liability about? What is the timing of the liability? When does the liability expect to happen? And so forth. In traditional theoretical, I think was your word, in theoretical accounting, theoretical statistics, how do I calculate that? Well, I say it's simple. It is the risk-free rate plus the illiquidity rate, the premium for illiquidity. Risk-free, very simple to calculate. We all know what risk-free is. Liquidity, illiquidity, a little bit more difficult. How do I decide what the value is that I attach to illiquidity of a liability? What is the value I attach to the fact that the payment, I can't sell it, I can't, all of these things come into that equation. So when we went out with this, a lot of people said to us, look, that's really difficult. And I think in your presentation you also said calculating those numbers is very difficult. And even risk-free is not all that easy. Because risk-free is a number we normally associate with government bonds. Government bonds are risk-free. I'll tell that to anybody who's sitting with Greek bonds right now. Okay, so there's not necessarily an easy place to pin this on. Also, these cash flows are all over the place. They're very, very difficult. So exactly the same way as I think Solvency II is doing now, we say, well, what you can do is you can create a hypothetical asset portfolio. You can create an asset portfolio using all of the things that, all of the timings that you believe are appropriate for the calculation you're doing. So I get bond instruments for the short-dated stuff with maturities round about the maturity buckets I expect. I get perhaps corporate bonds that I would build into that. All of the things that I think help me make up a hypothetical portfolio that roughly manages my liability. Now, you're never going to get it exactly right. It's an estimation technique. It's an estimation calculation. And then what I do is I subtract from that bond portfolio, I subtract from that discount rate I've calculated, things that are only relevant to the assets. What kind of things are those? Well, they're things like credit spreads. Credit spread is only relevant to the asset. I subtract those things out of that asset portfolio. So what I'm doing now is I'm working, previously I said I'm working from the bottom up. Now what I said is I'm actually working from the top down. Okay, so I'm doing a calculation from the top down. Now anybody again who studied any kind of markets and the point again that I think Christoph made about the efficiency of markets and how we assume markets are efficient but we know they're not. We know, and I actually took down the word but I've now forgotten it, you call it behavioral, something behavior. Behavioral finance, which I really like that term. Because what I think behavioral finance means is I think behavioral finance means that even when there are perfectly rational reasons for a market to move in a particular way, it might move in a different way purely because that's the way people feel at the time. They feel like they want to get out of something. They feel the market doesn't always operate rationally. The advantage of a top-down approach, the advantage of taking a top-down approach is that I'm starting with the rate that's available in the market, and I'm subtracting all of the known things from that. The unknown things, the behavioral finance numbers, get left behind in this number that I've got. So I might start and say 10% is the market rate. I subtract from the 10%, 2.5% for credit spread. That leaves me with 7.5%. If I started from the bottom, I might say the risk-free rate is 5%, and my illiquidity premium is 1%. That gets me 6%. What's the difference between the 6 and the 7.5? The difference between the 6 and the 7.5 is behavioral finance. It's the sentiment. It's the odd things that come into the space. What is the advantage of using a top-down rate? Well, when you're valuing your assets, you're effectively using a top-down rate. You're starting with the market rate. Now you're using the liability, you're stripping out only the things that are specific to that liability. That means the behavioral finance numbers are sitting in my asset and they're sitting in my liability. I'm getting some element of matching. So the top-down approach helps me achieve an element of matching between the way I price my assets and liabilities. Important thing though, time value of money should still reflect the characteristics of the liability. And what I'm talking about now are simply ways of actually calculating those characteristics of the liability. Okay. One other point about time value of money to remember, I said it must reflect characteristics of liabilities. Now sometimes an insurer will sell a product that says, I will sell you a product that will pay out a number that is linked to what's happening in the underlying assets. So if interest rates are higher, I will pay you more. If interest rates are lower, I'll pay you less. It's linked not to specific assets, it's linked in general to assets, to just the general pool of assets, to the general market. In that circumstance, because the liability is linked, the characteristics of the liability are the same as the characteristics of the asset. So remember I said one of the interest numbers that you have to remove when you're doing that top down, is you have to remove credit spreads. You remove credit spreads because they're only relevant to the asset. However, if the liability is linked to the asset, then a credit event on the asset affects the liability. So the credit spread is equally relevant to the liability. So in that case, I should use the rate that I would use for the assets because they are identical rates. Okay, everybody making sense so far? Is this still working? All right, so the next step. So we started 2, we've got cash flows going into the future. Now we said on top of cash flows, we're going to take time value of money and discount it back to the present. So what we've got is a value already. We've already got a value, a number that actually counts. The next, and hopefully, this number is an asset. Because hopefully, my expected future cash flows, discounted back to today, give me an asset. Okay. Otherwise, I'm writing a loss-making contract. And I think, Vienna, when you were talking about the 5% versus the 1.75%, you were talking about exactly the situation. Maybe sometimes, for some reason, I might write an insurance contract that gives me a loss on day one. But then I'm pretty silly, and I'm probably not going to stay in business for very long. So hopefully, when I do this discounting, I've got an asset. The next step I look at is the risk adjustment that I make to that instrument. Okay, what is risk? Yes, sir.
It refers only to the liabilities that are linked with assets, not to whole portfolio of liabilities. About this credit risk.
Correct. So you need to look at the characteristics of the liability, and if the characteristics of the liability reflect the characteristics of the asset, then yes. If they don't, then no. Okay, risk adjustment. What is a risk adjustment? Risk adjustment is quite simple. If I'm looking ahead and somebody says to me, put down cash now, at the end of the year, we will flip a dice and either pay you 0 or pay you 1,000. The average of that is 500. Okay. Very few people in that circumstance are going to put down 500 because I'm taking a risk. I'm taking a risk I might get nothing. Okay. Granted, I might get 1,000, but I'm taking a risk I might get nothing. On the other hand, if I said, put down 500, we'll flip a coin, not flip a dice, flip a coin, okay? If the coin comes up heads, you get 500. If the coin comes up tails, you get 500. Well, the hell, I'll put down 500, because I'm getting 500 back. It doesn't really matter. So on a coin toss that says 500 heads, 500 tails, I'm happy to put down 500. There's no risk in that. On a coin toss that says 0 or 1,000, there is risk. Okay, and I probably wouldn't want to put down the full 500. I want to put down a little bit less. But if I went around the room and asked each of you how much you'd put down, it's probably a different amount. And it talks to how much you would like to get that 1,000. The more you want the 1,000, the more you're likely to put down. The more you're scared about getting the 0, the less you'll put down. Okay, that's risk. Risk is about how scared am I that I'll get 0. How excited am I about potentially getting 1,000? And the important point about it, the important point about going around the room, is each of you will come up with a different number because each of you has a different risk appetite. Your appetite for risk differs. Now, for many insurance companies, when they're looking at this, they've actually got quite a small risk appetite. You'd be surprised how small risk appetites tend to be. Why? Because nobody wants their company to go out of business. But at the same time, we're weighing up that risk appetite, we're weighing up the risk of going out of business with the potential for making more profits. And that's the equation that everybody goes through. So we don't tell you how much your risk should be. We don't tell you what the risk adjustment is that you need to actually put in, what that number is. We say you need to look at your own models, at your own way of pricing products, at the own way you think about products, and you need to determine a number. And then once you've determined the number, you need to be consistent in the way you use that number. So the easiest way for me to think about this is confidence levels. So confidence level, many insurance companies will say they want to make profit in 99% of their scenarios. Werner, I think it was your slide that had and then a few that went down. So if you looked at that slide that Werner showed, you saw most of it was profit, and just a few scenarios gave losses. That tells you something about the insurer's risk profile. They don't want to make many losses. They've gone through all the processes of those scenarios. You've probably also done something to make sure that there's not one big scenario, one long tail kind of risk that makes a huge loss. So you've tried to cap that. That tells you about the risk appetite. That's a risk measure that an insurer puts on contracts to understand what those contracts are. So remember I said now I've discounted all of that, I've come back, I've got an asset. Out of that asset, the first thing I need to subtract is my risk margin. How much is available for risk? Okay, so that's the first thing. So now my asset is smaller because some of that has been put away for risk. The next part of the equation, the residual margin. What is residual margin? Well, it's everything that's left over. So I've discounted those cash flows back to today. I've taken account of my risk. But you know, I still want to make a profit. I still want to actually make something out of this process. So I leave something behind, a residual margin. Depending on which market you're in, that residual margin might be very big. Asia, Africa, you tend to find very high residual margins because the market isn't as sophisticated. So people are able to demand a higher price. Europe, US, Canada, the developed countries, you find much smaller risk margins because people have become a lot more demanding. There's a lot more, much smaller residual margins. People have become more demanding. There's much more focus on what the prices are that they're paying for those products. The residual margin, therefore, is my leftover profit, and I now subtract that from my asset. So on day one, when I start this process, my asset is zero, or my liability is zero, whatever I want to call it. Okay, zero because I have done the calculation, developed the asset, and then subtracted the risk margin, and whatever's left I've subtracted, and that's my zero number. Okay. The next minute, 1 minute later, I'm going to receive a premium. And as soon as I receive a premium, that premium effectively becomes the liability. Because it was zero, now it moves into a liability phase. We start building because all those future cash flows, the first cash flow has actually happened. Now sometimes the first cash flow is acquisition costs. So in other words, instead of money coming in, it's money going out. Okay? If the first cash flow happens to be a cost, the money going out, then on the first day my immediate first reaction is my naught becomes an asset. Simple journal entry. I credit cash because cash went out, and I debit my insurance contract. My insurance contract was naught, it's now a debit, it's now an asset. If the first cash flow in was premium, simple journal entry, debit cash, because I received money, credit liability, credit my insurance contract. And that's then how the insurance contract evolves over life. Now, I'm almost sure you guys are giggling in the corner there about how many of the complexities I've hidden, because behind all of these numbers, behind all of this is complexity. But what we are trying to do as much as possible from an accounting perspective is use the complexity that's already there to build our model. So build a simple model on top of the complexity. It does become more complicated later, and I'll talk about a few of the complications later. But in terms of the broad brush approach, that's the model, and that's how the model fits on top of the complexity that's happening. Any questions so far? Okay, so the next step is to now take this model, because remember we start with a model that is about a point-in-time liability, and now we want to update this model over time. So how do we update this model over time? At each reporting period, I start with each of these blocks. I start with the very bottom one, cash flows. And I say, have my expected cash flows changed? Have I decided that a person was more risky or less risky than I thought? Have I decided that a new illness has come in that's changed the expected life the life expectancy of people? Has a new medical treatment come in that's changed the news? So I need to relook at my cash flows at each reporting date and decide whether those cash flows are correct, and if not, I need to update them to the new cash flows. So I'm going to change my cash flows continuously over time for new events, new information that comes to me. I'm going to change my time value of money. Why? Because interest rates change. So as interest rate changes, I need to change the time value of money to reflect the new time value of money that comes along. I'm going to change my risk adjustment. Okay. Why? Same point. Risk changes over time. I might decide that a contract becomes less and less risky over its life. Because effectively I'm looking, at the beginning I'm looking 60 years into the future. 50 years down the line I'm only looking 10 years into the future. So it should become less risky over time. But something might change that risk profile. There might be a change in legislation or a change in the way society looks at the way I'm acting. Anything like that might change my risks and might make me think differently about the risk. But remember, risk is about uncertainty. So if I have a change that says I now have to pay 100 that I used to think I only might have to pay, that's a reduction in risk. It's a change in my cash flow expectations. My cash flow expectations go up, but my risk actually goes down. There's less chance of me having been wrong. So these are the things that you need to be changing in the risk adjustment. The residual margin at the starting point is easy, because residual margin, that's my unearned profit. And all we say about unearned profit is that I must take my unearned profit and I must earn it over the life of the transaction in a pattern that reflects the benefits that I'm transferring. Now, for most insurers, the pattern that represents the benefits that I'm transferring is I take the total expected life of the contract, let's say it's 50 years, and I divide the residual margin by 50. Cool, I'm done. It's as easy as that. All right. Not quite as easy as that, because we'll get to a few complications, but as a starting point, that's the way residual margin happens. So the next important thing to think about this page is that we first determined what each of these building blocks was, and then every time we report, we need to redetermine what each of these building blocks is. Okay. This is a horrible slide that I'm immediately going to bounce straight off this slide to the next slide, and this is where I've cheated. And interestingly enough, I've just noticed that I've cheated slightly wrongly. So this is page 8, and the next page is 7a, but let's not worry about that. What I've done is I've taken this slide and I've broken it down into pieces. Okay. So if you can just imagine that the page number on the top there is page 8a. Now the reason it's called 8a and 8b and 8c and 8d is because you don't have these in your pack. And so the only way I could keep the numbering the same for the rest of the slides. So this is simply breaking down that one into ways that I can explain it. So for you, focus on this slide while I talk through the other ones. So first thing, what happens? My residual margin, as my residual margin is released, as it gets smaller over its life, so that goes to profit. And that profit is called the underwriting result. Now, importantly, what I'm talking about here, on the previous page, the previous slide, we were talking about the balance sheet. We were talking about the liability and how you build the liability. What we're now talking about is how do changes in that liability translate onto my income statement. So the release of the residual margin, the earning of my unearned profit, becomes part of my underwriting result. Okay, and that simply goes straight to the underwriting result. Changes in my risk adjustment. So changes in the quality, quantity, and price of uncertainty goes straight to my underwriting result. Now, generally speaking, risk just releases slowly over time as I move closer to the final date. But as I mentioned earlier, there might be some abrupt changes. So any changes in risk adjustment go to underwriting results. Cash flows is interesting because it gets slightly more complicated. If the changes in my cash flows are related to past events or to current events, what I mean by that, I realize in this current period, in the current year that I'm busy doing, that I've got a claim I didn't expect to have happen. So this claim wasn't part of my cash flow calculations. Then that claim that I didn't expect to happen is part of my underwriting result. It's an unexpected or a change in expectations, and it goes to underwriting results. If something happens, if I realize something happened in the past relating to past cash flows, so anything that has already happened must go straight to my underwriting result. But this little squiggle going up the outside, the little line that goes from cash flows to residual margin, says that any changes that relate to future services, any changes in my cash flow that relates to something in the future, goes to my residual margin. It doesn't go to my income statement. So what does that mean? I'm sitting here, I'm looking at my life tables going out into the future. We've just had a change in life expectancy that says it's not 100, people don't expect to live for 100 years, they now expect to live for 110 years. That means I've got a change in my future expectations. I've got a change in my future cash flows. The effect of that change in my future cash flows goes into residual margin. It affects my unearned profits in the future. Now, one of the reasons why we've done that is because when I'm trying to estimate something that's going to happen in 100 years, or happen in 50 years, or happen in 70 years, there's an awful lot of uncertainty. It's very, very difficult to figure out what that is. But changes in the future can have a big effect on my assets and liabilities, on my liabilities in this case. They can have a big effect on the numbers. They can have a big effect on the expected profit I anticipate making from the contract. So we want to dampen the income statement. We want to dampen the current performance for those far in the future changes. So you take them to your shock absorber, which is your unearned profit. It also makes sense for a different reason. If I suddenly discover that I got my expectations wrong, and because I got my expectations wrong, I've made a smaller profit than I expected to make. If I didn't take these changes to residual margin, what would happen is I'd suddenly show a loss now, and then next year, this same contract that I showed a loss on this year suddenly becomes profitable again. Which doesn't really make sense, because actually the profit, the decline in my profit, relates to all the years. Okay. So in essence, what you've got here is you've got a shock absorber. The residual margin, the unearned profit, is a shock absorber for any changes that happen in your expected cash flows. Okay. Does that make sense to everybody? If there's no residual margin, that's the next slide. So let's look at what happens if there's no residual margin. What's happened now? And thinking about the residual margin, you can sort of think about it as your piggy bank. It's your unearned profits. It's the profits you're going to earn in the future. If I'm going to earn less profits in the future, I'm allowed to take out of that piggy bank. I'm allowed to take out of that bucket. If I'm going to earn more profits in the future, I have to put it into the piggy bank. I have to put it into the buffer. But what happens, and that was the question from the back, what happens when my piggy bank is empty? I've now taken all my future profits and I've got no future profits left. In that circumstance, it goes straight to underwriting result. I take the losses then as soon as they happen. Why? Because I have no buffer left. I've got no future profits left. So now any losses that happen as a result of changes in expectations must go straight to my income statement. You would have heard it on day one when we talked conceptual framework. You've heard it a little bit when we were talking IAS 39 and other things. Philosophically, we don't like to delay recognition of losses, but we're very happy to delay recognition of profits. Okay. Did you have a question over there, Vienna? Okay, all right, perfect, okay. All right, so we've covered now most of the building blocks. There's one building block left, and I've left this one to the last because it's the hardest one. The building block that's left is the time value of money. So remember what I said is that every time the discount rate changes, every time market rate changes, I'm going to re-present value my amount. That re-present valuing of the amount causes a lot of volatility in insurers' results. They go up and down significantly. So what we do here is we say you split the time value of money into two parts. The first part is the interest component based on the original rate that you determined. So what was the original rate when you loaded the contract? That is the interest component, and that goes through interest on insurance liability. It goes through above the line. It becomes part of your profit and loss. The second part of this equation is the changes that result because the interest rate has changed. So two things happen here. One is the unwinding of time. It's interest. It's the unwinding of the discount as I get closer to the final date. The second part of this is the changes in the discount rate, the changes that occur because the market moves up and down. And those changes in discount rate go to OCI. Okay. Remember what we said about OCI over the last couple of days when we've talked about it. OCI is like a buffer. It's like the safety zone where we take things so that profit and loss is not too volatile. So in effect, this is simply taking that profit and loss, that movement in interest rates, into OCI. So when I think about what the insurance financial statements are going to look like, the underwriting result is going to tell me about the release of my unearned profit, the release of my risk adjustment, and any changes in my assumptions about past and present events. The changes in my residual margin over time tell me about the release for services I've provided, plus or minus the changes in my cash flow about future events. Interest, the interest charge that comes through, tells me about the unwinding of discount over time. And OCI tells me about the changes in interest rates and how changes in interest rates have affected me. The other things that appear on the income statement are my investment income. Obviously, when I'm getting all this money in at the beginning that I'm only going to pay out at the end, I do something with that money. And what I do with that money is I use the money to buy financial instruments. Now, hopefully, if the changes we talked about yesterday in classification and measurement go through, then though in some form, then those underlying investments will also be at fair value through OCI. Fair value on the underlying investments means I will show interest in profit and loss, and I'll show changes in interest in OCI. So I'll get matching of the way my balance sheet works. It'll be similar. And the interest numbers, again, remember what we said earlier in the discussion, the interest numbers are based on the same starting point. I start interest from market for assets. For liabilities, it's market minus the things that are only relevant to the assets. All right, what about short-term duration contracts, contracts that are 12 months or less? Now, what the IASB has said is we have one model. That model that we've just talked about, this one that we were talking about, is called the building block model because we build up over time. We only have one model, but we have a practical expedient that says if you have a short-term model, if you have short-term, short-duration contracts, and applying our simplified methodology gets you roughly the same answer as the building block method, then you can use the practical expedient. What is the practical expedient? The practical expedient says I sit on day one, I look forward and say what is the present value of the premiums I expect to receive. That's my liability. That's my asset, because that's money I expect to come in. What is my liability? My liability is equal to my asset. So I start day 1, 0, exactly the same as I did on the other model. Then over time, as I receive each cash flow, I take that cash flow to this asset liability number. So if I receive a cash flow, it will immediately make it a liability. And over time, I release my liability as time passes on a pattern that reflects the benefits. So if we're talking about car insurance, I'd probably say I'm equally at risk of a loss every month of the year. So I'd release the liability 1/12 every month over the year. So I simply release the assets and liabilities equally like this over a period of time. We say though, and remember I said that if this simplified method roughly reflects the same numbers as building blocks, you can use it. If your contract is 12 months or less, you can assume it does. So you can just go ahead and use this easy method. If your contract is 12 months or longer, is longer than 12 months, you then have to actually test whether the two methods give you roughly the same answer. And if they do, you can use the short-term method. You can use this easy method. The easy method also allows you not to use discounting, because a lot of times discounting is not going to be relevant if you're only talking about a 12-month contract or a 1-month contract or whatever. So there's a whole bunch of ways to make this thing easier. Okay. Judgments and estimates, and there was, I think, both Vienna and Christoph had slides that talked about all the uncertainty, particularly long-term insurance contracts, but lots of insurance contracts have an awful lot of subjectivity in them. Sometimes they're no active markets, sometimes they're long, a lot of the time you're talking about long durations. In contracts with discretionary features, you have a lot of entity discretion that comes into the equation. I get very nervous even talking to actuaries because there is so much actuarial complexity behind the scenes. The cash flows are inherently uncertain. I'm making estimates about when I think people will crash their cars. I'm making estimates about when I think people will die. That is all uncertain stuff. So there's an awful lot of uncertainty that's apparent in these models. So all of this adds up to a lot of subjectivity, but the subjectivity is not because of the accounting. The subjectivity is because this is an uncertain business. And so we've got to cater for that uncertainty. So what we've really said across here is that an insurer needs to use its judgments, it needs to use its assumptions, it needs to be consistent in how it uses those assumptions and judgments. It needs to use the same information it's using internally for external reporting. So it can't tell its management one thing and try to tell its shareholders a different thing. It can't tell its regulators one thing and try to tell its shareholders a different thing. It needs to be consistent with those assumptions and judgments it uses. But still, even some of those numbers that you're using might not be entirely verifiable. So there is a lot, because there's assumptions, because there's judgments, there's a lot of uncertainty. And how does the board always fix uncertainty? Okay, very easy. We use a lot of disclosures. So there's a lot of disclosure that we're required under this standard for insurers to explain how they've done things, how they've got to the calculations, what the calculations are, what the background to those calculations are. The disclosures really fall into three categories. What the amounts are, so you give reconciliations, you talk about how the amounts have changed from the prior period to the next period. You need to tell people what judgments and estimates you've used, so what judgments you've used and how you've gone around estimating the numbers you've used. And finally, you have to tell people about the risks inherent in your business. So we said there's a lot of subjectivity, and that subjectivity relates back to risk. Not knowing when somebody dies, when somebody might die, is not just a judgment, it's not just an estimate, it's also a risk, because those people might die before you expected them to. So some of these awesome graphs we saw earlier when Vienna was speaking, those graphs that show the lines up and the lines down, those are useful things to tell the users of financial statements about the risks you're taking, about the possible risks on particular contracts. So a lot of that will start coming into the kind of disclosures we're talking about. The next couple of slides, and these slides here, just talk about specific line items. I'm not going to go into these slides because I don't think they're too important. They're not a major part of the discussion. So the next slide I want to go through is all the way to, I think, what is slide 20, which is the feedback we're searching for. Now remember, I said this project's been going on for a long time, 15 years. We've already asked everybody a lot of questions. So in this round of the discussions, in this exposure draft, we're only asking 5 questions. We're asking about presentation. Should we show premium income, or should we simply show the net margin? We're asking about whether we should use OCI, whether OCI makes sense. Asking about whether or not we should use residual margin as a shock absorber. So whether we should use that unearned profit to absorb the shocks of changing in cash flows. We're asking people whether it makes sense to do that. We're asking about that link between assets and liabilities and whether that link makes sense and how far we should apply that link. We've got something that we've called mirroring in the proposals, and what mirroring says is that if there's a contractual link between the liability and the asset. So one type of product simply says that if the market goes up, we'll pay you more. If the market goes down, we'll pay you less. Okay. That's not a contractual link. That is simply a promise that we'll make you certain payments. A contractual link says, if the share price of BMW goes up by 10%, we will pay you 10% more. And if the share price of BMW goes down by 10%, we will pay you 10% less. It's a direct link to an underlying pool of assets. And if you've got a direct link like that, you want the liability to show exactly the same value as the asset. They must be linked. So mirroring says where there's a contractual link, you directly. And we're just asking people whether mirroring is operational, whether it can actually be done. And then we've asked some questions about transition, because transition in this business is very tough. Why is it very tough? It's tough because sometimes I have to go, remember what we said about normal transition? Normal transition is fully retrospective. Fully retrospective in long-term insurance might mean I have to go back 50 years, and I have to apply the standard from 50 years ago. Nobody's going to be able to do that. I don't care how good you are. I don't care which country you're operating. I can't believe anybody can go back 50 years on their 50-year-old contracts. So we've tried to make it easier for people, and we're asking whether the way that we've made it easier makes sense. And then we have one overriding question. Okay. And if there's one thing that I'd like to hear back from you guys on over the next couple of months, if there's one thing I'm hoping to hear back from you guys on over the next couple of months, is how complex is this? Is this model too complicated? Is it just too damn hard to do? Okay. we need to find out whether that's the case. Okay? Because we need to understand whether, in trying to accommodate things like OCI, trying to accommodate things like mirroring, trying to accommodate things like unlocked residual margin, have we just made this thing too complicated? And so that's another one of the questions we're going to be asking. And that, I think, is the end of my presentation. As I say, there are a lot of additional slides in there. The additional slides hopefully provide you with a lot of background information, a lot of additional information you can ask on. You've got the email address that I put up earlier in the show, so feel free to ask questions if you get a chance to only look at them later. But are there any questions right now anybody would like to ask? Any final questions? She's just got her own microphone.
Actually, my question concerns technical reserves, the fair value of the technical reserves, because we have to deal with this issue when one insurance company buys the insurance portfolio of another company. It doesn't buy the non-current assets. It only buys the insurance liabilities and pays some money for it, probably for the client that it's acquiring. It may be my question may be connected some way to IAS 38, but anyway, we have to evaluate the fair value of technical provisions, and the sum of our money given and the technical provision is the goodwill, right?
Okay, so in the case, let's think of what we're buying here. Is in this circumstance, we're buying a financial instrument. Okay, because you're buying just the reserves of the company. You're just buying the insurance contracts. Are you buying the whole company? Yep. So if I buy insurance contracts, they're sort of like financial instrument. What I would do with insurance contracts is I go to this and I say, okay, what are the cash flows I just bought? What are the future cash flows? Place of value. What is the time value of money that I just bought? Okay, place of value on the time value of money. What is the risk adjustment I just bought? That either means, once I've got a calculation of that, I've got a number. So let's say the number is 100. If I paid 110 for that, so I paid more than what those three add up to, the difference is goodwill, and I'll treat it as goodwill, and that's fine. If I paid less, now remember what IAS 38 and those things say, that if I paid less, then it's not goodwill anymore, it must be something else, it's negative goodwill. In that circumstance, if I paid less, though, what I have now is I bought residual margin. And I'll recognize the residual margin the same way as I'd recognize normal residual margin.
All I am buying is liabilities. Why do I account for the difference as goodwill? Because I am buying liabilities, I'm paying money. Isn't it the sum of both, not the difference that is the goodwill?
What you're actually buying is you're buying two things. You're buying a liability, absolutely, and I agree with you. But you're also buying a client relationship. Because you've
goodwill.
got
Do we show it as an asset, or it's in the goodwill?
It's included in the it's effectively included in the goodwill, because goodwill is for assets that we can't really put a label on. And in this case, an asset that we can't put a label on is client relationships. It's very difficult to determine what that value is. Okay.
Thank you.
I got the approval to ask another question. Now, first of all, thanks for the excellent presentation. This was, for me, very interesting. Maybe if you allow me to go back to the income statement. And I guess you actually skipped one slide where the answer might be written later on. But let's stay here. What do you consider as revenue then?
What I consider as?
Revenue.
Changes in estimates, you mean?
So the first line, insurance contracts revenue. Revenue.
Oh, revenue. Okay, sorry. So that's the whole discussion of premium. Okay.
Yeah.
This is a discussion that we're having on an ongoing basis, and you're right. This is an issue I sort of avoided.
Okay.
When we started, the original proposal that we had here was we originally proposed that you just show your margin. So you just take your residual margin plus your risk adjustment, plus any changes in those, and that was your underwriting margin, and that's what you disclosed. A lot of people came back and asked us that they would like to see a gross number, a big number, because they said everybody's income statement starts with a big number, and then it works its way down to profit. And the big number in insurance is premium. So the premium number is a number that is then quite important from the perspective, and it's important because insurers want a number that looks like revenue. So the board talked about it and said, okay, if we're going to give a revenue number, if we're going to give something that is revenue, it needs to obey the same rules, the same principles as revenue. So we looked at the normal measures that insurers use in this space, premium due or premium written, and we said, are those like revenue? Well, what is revenue? Revenue is the amount I receive for the performance obligations I have delivered. Okay. If I think about something like a life policy, a life policy I pay the same amount when I'm young as I pay when I'm old. But the performance obligation I'm receiving from the insurer is worth less when I'm young and worth more than when I'm old. Why? Because I'm more likely to die when I'm old. So what we said is that if you choose a revenue number, it needs to be a revenue number that reflects the performance obligation you're giving. That means premium due might be the right number, and for example, in short-term contracts, in health contracts, and some of those contracts, there might be a direct link between the premium that I'm actually receiving and the service that I'm delivering. But in some other contracts, there might be cross-subsidization. I'm paying too much when I'm young, and I'm paying too little when I'm old. And that means that you have to recognize, if you're recognizing according to revenue standards, you would recognize less than you're receiving at the beginning, and you'd recognize more than you're receiving at the end. So there's a change in pattern. The problem we had with premium due is premium due reflects effectively cash flows. It's showing the cash that's flowing into the business, not the revenue the business is earning, because it might have to deliver more services in the future. So we came up with something completely new, something that reflects that pattern of performance obligation, the pattern of performance delivery, and means that for some life policies you'll recognize less than your premium due at the beginning and more than your premium due at the end. We're asking the question in this thing to say, does that make sense, A? And B, are you comfortable with the additional complexity it introduces? From a board perspective, we think premium due is misleading, because premium due, if I take an annuity, I might pay the whole premium on day one, okay, and only receive the benefits over many years. To show that as revenue is incorrect. To show that as sales, because you need to spread it over the performance obligation. So we've kind of given two choices in the exposure draft. We say either premium earned, the concept that we've invented, the new concept we've come up with, or summarized margin, the concept which we probably think is the most correct concept, but we battle a little bit with it anyway. Does that answer?
What was the second one?
The summarized margin approach.
Okay. Maybe my problem is kind of the underwriting result as you described it is basically kind of, let's say, a discounted figure, right? It is a present value, more or less.
Present value number.
Yeah, but talking about the premium, it is one piece, or you might say one cash flow, one part of a premium cash flow.
Yep.
Long-term contract has like maybe 25, 30 premiums coming up. Yeah. So shouldn't this then be also a kind of a present value?
And in essence, that's what's going to happen, because remember what I'm doing now is, in order to get this calculation the way we're talking about it, and that's why, particularly for preparers, you need to take quite a deep breath when you start talking about this, because it does add complexity. Yeah. How am I going to do this calculation? I'm going to estimate the present value of all the premiums I expect to receive. And then I'm going to say how much of that total amount of premiums I expect to receive is relevant to the risk that has been transferred in this period. It's not going to be the amount I actually receive in cash. It's going to be a different amount. So it's consistent with the calculation, but it's not going to be the easiest calculation you ever do. Maybe that's why the actuary is asking the question.
Exactly.
We're working very hard to make sure you've got a job for a very long time.
Thank you. Excellent. Thank you very much.
Sure. Any other questions? Excellent. Thank you very much.